How do you determine what the best funding is for you as you're looking to build and fund growth in your company? By making the right informed choices on funding options, you can avoid pitfalls and regret down the road. In today's episode, we are going to provide you with the keys on what funding options are available to properly capitalize your business for sustainable growth. You will hear what that journey looks like and be presented with a roadmap to financial success and freedom. Hello, and welcome back to the Nebraska Entrepreneur, the podcast for Nebraska entrepreneurs who seek candid guidance from Midwest leadership. I'm Steve Canny, and I've been a successful entrepreneur in Nebraska for over 20 years, helping and mentoring entrepreneurs and business leaders across the country. Today, we're going to show you how to grow your business by finding the right funding service to grow the company. Joining us is a successful entrepreneur and the founder of Dundee Venture Capital, Mark Hasebroock. Well, Mark, thanks again for joining us today on our podcast. I haven't known you a long time, but in the short amount of time I have known you, I've really gained a lot of respect. And I had respect for you before I even knew you, but I've really gained a lot of respect for you as an entrepreneur and helping other entrepreneurs. It seems like a passion of yours. What I'd like to start out with is if you could just give us a 50,000 overview of your career as an entrepreneur,
right? Which
then kind of leads us into what we're going to be really.
We've got 45 minutes for that story, right?
We have 45 minutes, so take your time, talk slow.
Right? No, I'm an Omaha, Nebraska native. I haven't strayed real far. I've always had entrepreneurship in my blood without realizing it. I just like building things. My first business was in college when I sold moccasins to sorority girls to fund a trip to Padre Island. So I had a real big dream, at that point. But I've always enjoyed building things. I was a stint as a banker. I was in investment banking for a while, but then ventured into my own businesses. One was a popcorn business, Vic's Corn Popper, if you might remember that.
I remember that, yeah.
So we had some retail stores. We wholesaled popcorn. I was also in a business called giftcertificates.com in the late 90s, which was an online retailer of gift cards, gift certificates. Mm-hmm. And this was the heyday of the craziness of the internet. Mm-hmm. In fact, I don't know if you knew this. You can go back and look on Amazon, your first purchases.
Yeah.
And my first purchase was a book called How the Internet Works. So it was like 96 or 7, and none of us knew. It's sort of like what AI is today.
Yeah.
Like everybody knows it's going to be powerful and it's going to have an impact on our lives, but at the time the internet was sort of like, what is this thing? This is crazy. Anyway, so we had a business called giftcertificates.com and had a lot of fun with that. Learned absolutely everything on how not to fund a business and grow it through gift certificates, and then started a business called Hayneedle, which was an online retailer basically for stuff for your home that you don't need. Mm-hmm. And that one we probably did better, and we funded the right way, grew it the right way, ultimately sold it to Walmart, and then I started a business called Dundee Venture Capital, and we invest in startup technology companies all over the United States at that really early stage, mm-hmm. when they're sort of like friends and family have said, okay, enough, mm-hmm. to let's get that first round of institutional funding. And it's very risky, but extremely rewarding and entertaining at the same time.
Yeah, it sounds like it. I have some experience of taking outside money from a family office, and mm-hmm. like I've told you the story before, it was very successful. We found the right investor at the right time. Mm-hmm. But that's really today what we want to talk about is for the entrepreneurs out there that are looking to fund their business, capitalize their business for future growth, whether it be slow, sustainable growth, or just they want to blow the lid off of it, mm-hmm. Try to build it to sell it, maybe. Just for those people that are listening right now and watching us, what are some of the types of funding most entrepreneurs are going to look at, or what are some types that are available to them that that you'd like to share?
Sure. I think they really should start with how much cash do we need to operate this business for the next 18 to 24 months. So start with that question first. And that then drives, well, what is this business going to look like in, say, 2 years? Mm-hmm. And that gets everybody on the same page on the team, because oftentimes what I find is that they are on different planets a little bit. Mm-hmm. I think we're going to do $1 million in sales. I think we're going to do 20 million in sales. It's like, hold on, let's work from 2 years backward to today, and then let's build. What do we need for cash then to drive that business? And too many times the question always is like, well, I better go talk to VCs. I can tell you that's probably not the thing you want to do. You know, first of all, just get on the same page with the plan, the pro forma, the cash needs, and then start to examine what sort of resources are out there. There's traditional debt, not super open right now for entrepreneurs unless you have a house and all sorts of assets that they can secure.
Yep.
There's the old friends and family round where you basically pass the hat after you've determined how much cash you need. Let's just get the absolute minimum. I always tell founders, don't raise equity unless you absolutely have to, because it's like island real estate. Once it's gone, it's gone. Mm. And so, you know, preserve your ownership as long as you possibly can. So if it's debt, there's revenue-based funding out there, meaning, you know, like the old Mr. Wonderful kind of structure.
Yep.
You won't give up any ownership. And then there's kind of hybrids where you can do some debt, some equity, and then there's, of course, just pure equity. Mm-hmm. I think a lot of those markets are really tight right now. Mm-hmm. Yeah.
So you're preparing your business because you know you're going to grow, but you know you don't have the capital to grow. What are some of the things as an entrepreneur we should be considering on how to get our business ready to fund that future growth, right? If we need to go outside to look for capital. You know,
we always say sales solves all problems. And the more revenue you have from just traditional sales channels, the better. And that makes people sort of put their noses against the glass saying, what's going on in this company? Boy, I keep hearing about it, and they're succeeding, they're doing well. You know, and then you'll start getting the calls. It's like, Steve, hey, you guys are doing great. You looking for some investors? That's ideal. The worst time to raise money is when you're almost out of cash, because then the story becomes, well, what's wrong with this business? And now you start attracting the wrong kind of partner. You know, the predatory partner who wants to own a whole bunch of the business and is going to have super demanding rights and tell you how to run the business, and you're just against the wall, and that's not what you want. So the more you can have proof points, the business is working, we got customers, there's no churn, life is good, that is when you really should be thinking about raising capital, because your valuation will be at its best right then. Yeah.
You mentioned, giftcards.com and that business, and you said that we learned the hard way on how not to fund it. Can you just share a little bit of that experience?
Sure. We had put together this model that I referenced. We said, all right, for the next 12 months, we think we need about $500,000. I mean, we're really starting to grow. We had funded it just internally and bootstrapped it. So we decided to go around Omaha and raise that money. We got a lot of pats on the head, like, hey, this looks fun, but, good luck. So, well, this is a real business. Yeah, it happens too many times to founders. We got through a connection to a company out in Seattle. And these were true VCs. We fly out to meet them, love the presentation, and they said, we just don't think you need $500,000. And we said, well, what do we need? He said, we think you need $5 million. And we want to provide it. All $5 million.
Wow.
And of course, we were so naive. We said, wow, great, let's do it. Why do we need $5 million? Well, if you look back at history and the late 90s, it was this crazy land grab where everybody was doing these nutty things, the web van, the pets.com, some real loony businesses that just sort of didn't make sense. And yet they were getting funded. tens, hundreds of millions of dollars.
With crazy valuations.
Crazy valuations. And going public with no sales. And so these guys said, this is the time. You got to grab it. And let us put the money in, and you really got to drive marketing. You got to hire all the engineering talent you need. You got to really make this thing, don't do this, do this. And we thought, man, I don't know. That doesn't feel right. Okay, you guys are smart. You're the money guys. That's what I'm referring to. We listened to them. Great guys, super smart, but they had something in mind different from what we wanted to build. But we followed that path. So by taking so much money, we got diluted big time. But the story that they were telling was like, you guys, you own a small piece of this, but it's an enormous, enormous pie. Okay, you guys are right. Well, we had to do that like 3 more times. And each round of funding was at crazy valuations, but our ownership kept going down, down. Yeah. I would not do that ever again. That was a mistake.
Yeah. So it's the old, would you rather have a small piece of a large pie or a big piece of a small pie?
Yeah. Because we went the whole path. Filed to go public. We owned a real small sliver of this thing, but geez, at the time the valuation was something like $400 million to go public, and we were thinking this is it.
Must be nice.
Well, the window closed, the whole world blew up, all the IPOs went away, and it was a tough lesson of how not to do it. And so if you remember on Seinfeld when they had the Bizarro World episode.
I remember that.
Yeah, so we're like, okay, Bizarro World time. What did we do there again? Let's not do that. And with Hayneedle, it started with one store. We called a store Hammocks is what we sold, but each store we successively built and tried to cash flow, and then ultimately rolled that up into one brand. But we were doing early data mining, if you will. So like you'd buy a hammock, we'd realize, why'd Steve buy a hammock? I mean, we would call the customer and just go, why'd you buy this? Say, well, I wanted one for my backyard. By the way, I'm looking for a porch swing. I'm looking for an Adirondack chair. I'm looking for and we'd say, okay, well, this starts to make sense. So we could market to them all this stuff. And so we funded it through internal growth, but at some point we got stuck.
You hit that ceiling.
We hit the ceiling. And so we did need to raise capital. Again, went around Omaha, told the same story, got the same response. So we went to out to Silicon Valley through some connections and raised money there. And in the back of my mind, I kept thinking, someday I'm going to try and fix that. Let's make that first round of funding more accessible. And because it shouldn't be that hard.
Right.
And there's a lot of great founders between the coasts. That just need access to that round. So that's what we started Dundee.
Yeah, and Omaha has a lot of money. There's a lot of people in Omaha willing to invest, but I think probably back then the technology piece was a little bit scary to them.
Totally,
yeah.
And risky too.
Yeah, risky.
I mean, Omaha is very, I would say, risk averse when it comes to that. And it's a big company town, and we have to recognize that. But embracing, and I think over the next generation, it'll take that long. The next generation will start to see a lot more creatives. The cost to start a business is much lower, and people will realize I can do that here as well as I can do it kind of anywhere. But it's going to take time.
So you paid a lot of tuition.
Yeah,
that's what I call that when you make those mistakes and then you get it's tuition.
Yeah, that's a great way to put it.
Getting your doctorate in entrepreneurship. So with Dundee Venture Capital, the firm that you've had going for a while now, so what's your typical advice to these founders? What do you typically tell them when they reach out to you and say, "Hey, I need help"?
Normally, they are super nervous, and they're prepared like this has to be Shark Tank pitch time type thing, and we just treat it as a conversation. Tell me what problem you're solving. Why is your solution going to win? Tell me about your team. What's your dream? I mean, what's your passion? Tell me about your family. Where are you going to be in 10 years? We never talk about the money, and they always lead with the money.
Yeah. And you're
like,
not sitting there going, no, not 100. I'll give you 500.
No, not at all.
Yeah.
Just like, and it always is like, hi, I got introduced to you, and we need to raise $1 million, and I think it's worth $10 million, and here's what we're going to do with the money. I says, let's just stop.
Yeah.
Because the stage we invest is a really long partnership, and if you aren't with the right investor, I mean, you've had a great experience.
Yes, I
and
have.
you know, great investor, and I know him well, and he's fantastic. And you want to make sure you've got the partner that's there for you, because it's a 10 to 15 year slog. This is not, capital, sell it the next year. So it's more about getting to know the team and the people, because it is a up and down cycle. And you have to know if these founders can ride that, terror elation daily thing, because that's what it is.
Yeah.
And they keep coming back to like, okay, so about the money. So hold on, let's go through the model. Let's make sure we understand each other. And is someone else already building this? And let's come back to you and your family. And because, as you know, building your company.
Yeah.
My God, they all got to be there behind you.
Yeah, the whole team,
right?
Aligned. Yeah, and your family definitely.
Yeah,
especially if you're married or significant other and your children. I mean, that's a lot of pressure.
It is.
And
that was born from, I think, for me personally, when we were first starting, particularly with hammocks, I was in my attic of my house.
Working out of your attic?
Working out of my attic. We had no offices, with the exception of Barnes & Noble at Crossroads, where we used to just, take all the books off the shelf, like, HTML for dummies, that type of stuff. But we used to use their Wi-Fi, but then I would go home and process orders. Well, we had 8 kids at the time. And they're all running around downstairs, and I'm up in the attic just like with dial-up, which you might not even remember dial-up.
I remember. I used to process payroll.
There you go.
With ADP on dial-up.
Yeah.
That was my really first true experience.
Right? And I would sit there and just be like, don't anybody touch the phone. So they pick the phone up, and oh my God, I'm disconnected.
Yeah.
So thinking back to those days of how my wife and my kids all knew that this was important, but I was there for them when I could be, and they were there for me. And you transfer that knowledge and relationship and experience to these current founders, the ones that say, why do you keep asking about our families? Because if it's broken or if there's friction, that isn't going to work.
Right. And
I don't care how much money we pour into it.
It's just not,
They're going to fall apart. And we've seen that, by the way.
Yeah.
Yeah. We've seen some. We had one founder who absolutely did not disclose that he was manic. Our fault for not uncovering it, but it was like, wow, everything seems great on the surface here, and a great family, and he's really driven by this problem that he saw. He just flipped out and disappeared.
So good investors like yourself are going to ask those questions.
Yeah.
They're going to do that diligence. Predatory investors, probably not so much. They're going to want 51%.
Totally. Yeah.
Preferred shares.
Yep.
They're going to want all this control, and then all of a sudden, I've never understood that actually, how that ever works out for anybody. I just don't. So
they get in that position where you and I have talked about, where they need cash, okay, and they come across this guy and they're like, my God, we need this money. And I suppose giving up control isn't that big a deal, and aboard seats, and 2x liquidation preference and all of this stuff. We just need the money. I got to survive.
Yeah, got to survive.
And so it's desperation, and it's unfortunate. Yeah, it happens.
So really, what I'm hearing you say, the best time to really, if you're going to, even if it's with the bank, traditional financing or outside investment, usually the best time to ask for it is when you really don't need it.
Yeah.
But if you want to grow and you need it to grow.
Yeah.
Like, I'm funding, my business is stable today, it's cash flowing, it's not going to be enough for me to do an acquisition or to set up another office or to start a new product line or even enter a new vertical market, those types of things?
It's communication, and not even saying we don't need the money. It's more about establishing relationships with the circle, and whether it's debt providers, accountants, attorneys, investors, venture funds, private equity funds, and just communicating. And not even saying we're raising money, we might raise money, we may never raise money. It's just like, hey, I just thought I'd give you an update. Here's where we are. Here's where we said we'd be. Here's where we're going. And by the way, always have an ask. Like, I need somebody to help me with. Who do you know at? And now, out of 50 of those emails you send out, one might reply. One might say, you know what? It's funny you ask. I know somebody at this company. I'm going to make an introduction for you. Or, listen, when you're ready to fund, give us a call. We got to know more about this. Okay, so you build this rhythm of trust, of constant communication. So they're like, man, I keep hearing about this company and these guys are doing great. Put them on the radar, and why don't you reach out and be more proactive with them, right? So they're aware of it. Expand that circle even more. Every single time you send out an update, expand it by 10%. That's the best strategy, because then when it's time to raise, everybody's primed and ready to go. Yeah,
that makes sense. I remember when we were looking for investment and found George, we had actually talked to several, and they were all local. Because as we figured, let's start local, get our pitch down, figure it out. But one of the things that we were told is make sure you have a plan of what you're going to do with the funds. So you're going to get the fund. If you get the funds, you better have a clear plan. Can you speak to that? Yeah,
you should have a data room, and just be building a data room. And in the data room should be, your business model. Why do we even exist? So it can be 2 sentences, it could be 10 pages. But it's something where you say, why do we exist? What problem are we solving? Why are we going to win? Why is our team the best? Then in the data room is financials. Okay, so if you're on QuickBooks, just have it in the data room and easily accessible. And then a pro forma. And so this is where, once people are grounded in the business, the problem, the team, they look at the historical numbers. Then they say, okay, now with $1 million, $10 million, 100,000, whatever it is, what does this business look like with the capital? I'd love to say our industry is like the ones driving all of this. We're not. We really want to make it simple.
Really?
Yeah, we want the investors or the founders to say, boy, if I had $1 million, this business would go from 1 million in revenue to 10 million over the next 3 years. And here's how we'd get there. I would use 300,000 for marketing. I would hire these new people. I would make sure I had this much cash available at all times. That's what we would use the money for. And then within the marketing, here's our marketing plan. Here's how we acquire customers. One of the most fundamental things in any industry is, what does it cost you to get a customer?
Yeah.
And you really should know that.
I bet most businesses don't know that.
They don't. And any time that we ask them, say, what's it cost you to get a customer? If they start with, well, then they don't know. But if they go, it's about $80. And our average revenue per customer is 250. So that's great. But then our lifetime value, because they order from us 3 times a year, and our average customer is going to stay with us for 7 years, you kind of go, oh, that math really works.
Yeah.
And they know it. Now I know my capital is going to go towards something like that is easily going to be scalable. Now, I'm a big believer in speed and stealth. Okay. Too many founders love to trumpet themselves and their company, and here's what we're doing, and here's how great we are, and it puzzles me why they go out on social channels and celebrate fundraising. Because you just put a giant target on your back.
Right.
Hey, look at us. We just raised this money. We just tell them, hey, guys, what you actually want is to arrive on the scene where the world goes, where'd these guys come from?
Yep.
And now it's too late. market share, dominant, best provider, and they're sprinting, even though it might have been a 5-year slog to get there. So speed and stealth. Show me what you're going to use the money for and really break it down and know those metrics. Because knowing those metrics, just like this, really important. And another thing that a lot of companies don't know is how much cash they have on hand.
They don't truly understand that. Yeah. A business like ours is a little bit that way because, we're over that 10 million threshold and we're a services business. So we need to understand what our work in progress is and our overbuildings, underbillings. It's just not easy. I remember when we switched, because initially we were cash basis, and it was like, how much cash do we got?
Right.
It's like, well, it's pretty easy. But today when you get projects that are, large 7-figure projects that span over 2 years, man, it gets tough. And I can see. So I'm assuming or guessing that, some of these companies you've invested in, you work with the owner or the founder, the management team to help them better understand their numbers.
We try to. I mean, there's only so much that you can do. And I think the thing I've learned is that I hear a lot of this phrase, value add investor. And frankly, I just don't see many of those. The best value add investors, and I learned this from Doug Leone at Sequoia, is you make introductions to companies and you find them talent.
Okay.
Those are the two things that you really should focus on. With an early stage company, what we try and put in place is the governance they need. Like, what does it mean to have a true board of directors? You might not need it yet. Some of that's way overrated, because they're young companies. They're like, God, we just got to get going. What do we need a board for? But you got to prepare for it, and so having all of that in place, and then what are the 2 to 3 key metrics to run your business every day? And so know those things like the back of your hand. We'll help you set them up if you need to. If you already know them, run with it. Early on, I thought, well, we're going to roll our sleeves up and look at us because we were, such great operators. We're going to dive into these businesses. I just think that you've got to let these founders find their rhythm and personality and do it on their own. And where you can add value is when they say, look, I need introduction to Steve over at Prime. Do you know him very well? Yeah. Let me make a call. He should know you guys. We're looking for a CTO. Where do I start? We'll help you. We've invested in about 50 companies, and through the network and plus seeing 25 to 50 ideas a month, we have relationships with late stage private equity to every single early stage fund there is in the United States. Wow, good job, Mark. I mean, it's not a huge industry. Okay. All we have is cash and our reputation. That's it. And so we've gone to great lengths to establish those relationships so we can help founders when it comes time. Odds are, if we don't know a way to get into a company, we know someone who does. Or if we don't know immediately who a CTO or a CMO or somebody they're looking to hire, we'll run our network and figure it out. Yeah,
that is and that's one of the things that I like with your business, Dundee Venture Capital, that I've recognized as a founder owner, like the partnership of that investment, right? I don't look, for me, with George, I never looked at him as an investor. I looked at him as a partner. And the most help that he's provided us is his connections in this market. Really just connections, his network. That was all. He didn't, and meeting with him was fun. We'd have great meetings, and he'd share the wisdom, and it was awesome. Learned a lot of stuff from him, but the true value was in his network.
Right.
Yeah.
His ability, and someone like that, their ability to boil down complex problems into very clear solutions is invaluable. Yeah, and having someone like that. I've been on the other side where you've got investors that just talk and talk and talk and talk and talk, and they control everything, and they do it this way and do it that way. And it begins to undermine your own confidence.
Right, yeah.
And then you start to question, why am I in this business again? What am I doing?
Yeah, you start to question, well, I thought I was doing the right things, and then I met you, and apparently I'm not.
Geez, I guess I don't know what I'm talking about. Well, thank God you're here, right?
Yeah, we all need to continue to grow, right, and get better, improve ourselves. But yeah, that's good.
Well, don't let capital drive the dialogue. I think the best thing you can do is just control what you control, run your business the way you want to run your business, but do over communicate with those channels. And in this day and age, it is so easy to do. And I get some really interesting updates from companies that we call them our anti-portfolio. We missed them, or we said no, or they're just still so early, but I'm getting updates on, oh my God, they did get that client. Wow, they are. This is impressive. Okay. Otherwise, I would have been out of the loop and not know what's going on. And with so many tools out there, as a founder, you can set this up on just auto. It can be every 2 weeks. Hey, just thought I'd update everybody. Here's where we are.
Yep.
And a lot of them delete. A lot of them, forward it. Some of them save them and archive them and do whatever. But it's so important. Then, when you need the capital, you can begin to assemble that. And go out. And the best way is to then go to that network and say, I'm not looking for your money, but who should I talk to about raising? We're targeting maybe $1 million. Again, you're not asking, but if they're smart, those investors say, well, you should talk to us.
Yeah.
Right? Let us lead this for you. And that's typically how it goes.
That's good stuff.
Yeah. It's fun. It's rewarding, and it's allowed me to kind of look around corners and see stuff that's coming that's really interesting, and exciting. So
awesome. Well, thank you for sharing that wisdom.
Yeah,
That's awesome. Appreciate it.
You bet. Yeah. Hopefully it's helpful.
If you want to achieve financial freedom, then click the link in the show notes now so you can take advantage of this free information.